Understanding risk and how it manifests itself in our portfolios is a key part of the investment process. And all too often, advisors and their clients may be too excited to focus on the other side of that equation, that is the expected returns that we see in the marketplace. And a thorough understanding of the risks that come along with seeking out those returns is really important and will help us maintain conviction to stay committed to our investment process when those risks do manifest themselves in our portfolio. And there's a few different kinds of risks we should be concerned about. The key one that most people are familiar with is standard deviation, that we're all taught about in our investing education, and the trade-off between standard deviation, which is measured typically as volatility, and the expected returns that we have, and how that trade-off can be maximized by looking at portfolios on the efficient frontier. Now, a U.S.-centric portfolio formed of 60% stocks and 40% bonds currently sits pretty far away from that efficient frontier. Our expectations are over the next 10 years, such a portfolio will deliver around a 3% nominal return and be exposed to close to 10% volatility. So investors can do quite a bit better by seeking out portfolios closer to the efficient frontier. A portfolio with 10% volatility along that frontier could deliver as high as a 5.5% expected return over the long run. We're exposing ourselves to a second kind of risk. And that's what can be described as MAVERICK risk, or tracking error is how it is often measured. And that's the risk of investors receiving different returns from their peer group, from their friends, or from their benchmark. And that can be psychologically very difficult. The experience of the dot-com bubble is a good illustration. Many people lost a lot of money in the crash throughout 2000, 2001, and that's reflected in volatility numbers, large negative returns. But it's a different experience entirely to have not been invested in the bubble in the run-up, to be falling short of one's friends and peer groups in 1998 and 1999. So as we make this decision to seek out more compelling long-range outcomes, it will necessitate taking on additional sources of risk, tracking error, and more volatility perhaps in your portfolio. What's really important is that investors understand the ramification of these decisions and what the likely impact will be on their portfolio in the shorter run, such that when these temporary shortfalls occur or when more volatile markets happen, we don't allow the fear and the behavioral biases that are ingrained in investor psychology to creep into our decisions and cause us to trade out of these portfolios and markets at exactly the wrong points in time. That we can recognize what's happened is simply a natural outcome of this process, to expect it to happen, and to remain committed to the long run and keep ourselves positioned to achieve these desired long run outcomes.